Tonight I want to go through my entire process. We will start out by covering how to create a trading plan, and from there we will look at building a flowchart for one of my setups which will help with fast forecasting. We'll look at how that translates into your daily prep, and from there how the trades taken are entered into a journal and some of the ideas you can consider for increasing performance in your trading career. So we'll start out with the trading plan. If you want to treat trading as a business, you should have a proper trading plan. We had to write one before we were allowed to trade in prop. So I'm going to show you how to create one that is absolutely bulletproof. And as you create your trading plan, you'll find that it makes you think about many things that you might realize you've never considered before. And that's good, because these are all things that will play a very important role in your business. So the way I'm going to do this is I'm going to scroll through this Word document and I'm going to show you a list of headings for elements of your trading that you should consider. And there'll be questions underneath them that you need to ask yourselves. And in many cases, I've provided examples of how you could complete these sections. Now, I'm not going to go through my entire trading plan, but you don't need to see my entire plan. What you want to see is the questions that you should be asking yourself and some examples of answers to those questions, in many cases lifted directly from my plan, but some I have made up, and I'll tell you which is which as we move through. So, first off, the quote. Now, obviously you don't have to have a quote at the beginning of your trading plan, but I always think that it's good to have a quote that motivates you. It might be something you've read in a book or seen on the internet, something that resonates with you, inspires you, or particularly motivates you. We have covered this quote before in EFL. It is my favourite quote of all time when it comes to trading, and I really think it epitomizes exactly how I personally trade, which is why I have it right at the front of my plan. Again, I won't spend too long reading everything. You can read it yourself, and if you're watching the recording, you can obviously pause it and read it more thoroughly. So moving on, the first part of the plan is why I want to be a trader. So here's where you list the reasons why you're trading. They could be to make money, to spend more time with your family, because you thrive on competition, and you may want to answer the questions below here to shed more light on your motivations. So for example, why did you start trading in the first place? What was it about trading that particularly attracted you? What do you want from your trading, and what will that give you? And what do you enjoy about trading? What do you not enjoy? Because that might give you an understanding of things that you might want to do in future. So, for example, when I first filled in my trading plan, this is exactly what I wrote. I want to be a trader primarily to make money. Trading appeals to me because I'm extremely competitive, and I believe I'll be able to make an extremely high salary, have the freedom of being able to work independently from anywhere, and spend more quality time with my family. Now that's all well and good, but then the second part, and you'll revisit this later, is going forward you want to consider, is this career bringing you what you thought it would initially? And an example of an answer to that question was actually taken from a student of mine's trading plan. So they put, I've realised from my experience in the market to date that I enjoy analysing and trading markets, and I am able to make money so far working from anywhere as I initially thought, but I don't like the lonely aspect of this business, and I don't feel any more connected to my family than when I worked in a 9 to 5, because even though I'm around them more, my mind is always on the markets, and I often let the emotions caused by my trading affect our relationship. So at that point you're going to maybe ask yourself a question of, is there a disparity between what you initially planned and the way things are going? And if so, what can you do about it? So again, going back to their example, this is what they wrote. I've analysed my data carefully and realised I rarely get trades on Monday, and when I do, I lose on balance. As a result, I've decided to make an effort to use this time for quality family time. I've also set up a private Slack group and invited some UK traders I follow on socials into it. We have some ground rules. Primarily, we agreed not to share trades or celebrate wins, lament losses with each other so that we don't interfere with each other's edge or mental mindset, but we collaborate with each other where we can. We submit statistics for peer review, we help each other with ideas to journal, and this, along with the banter, makes trading feel much less lonely for me. It's taken some time to build up a decent little community, but it's slowly growing and we're now all friends. So again, the point of this section of the trading plan is just to remind yourself of your motivations for getting into trading in the first place, but to also give you ideas of where you can improve things if there are aspects of this career that you are finding aren't to your liking. So a lot of people talk about the loneliness, and again, what this person's done is they've come in and they've thought, well, how can I get around this fact that I'm not spending quality time with my family as much? Right, I'll spend time with them on a Monday. That'll be family night. And I'll spend quality time with them because I know from looking at my journal that I rarely get trades on a Monday and I usually lose money, which is something, by the way, that I see among a lot of traders. They don't do well on a Monday. And then again, a private Slack group, someone's asking the question of, well, how do you know that other people you talk to aren't just pulling bullshit out of their arse? Well, you will know over time if you've got a good radar whether to trust people or not. But you can see here that this person specifically said we're not going to start calling out trades and telling people how much we've made or moaning we've lost money, because that will affect mindset. So we're going to use this to grow together. Here's some statistics. What do you think of this? Can you peer review it for me? Have you investigated this in your journal? So you're kind of sharing ideas and banter, but not really affecting mindset. And if you can get a little community like that, then that's something that is very beneficial going forwards. But again, you don't need to have that community, but this person has specifically tried to answer the problem of, I feel that trading's very lonely. So again, it's isolate a problem and fix it if you have one, or attempt to fix it. So your motivations for becoming a trader will then merge into your mission statement, which is where early on in your plan you'll write a short statement of your purpose. What are you here to do? How are you going to do it? And what will be the outcome if you do it? So this is like a constant reminder of your purpose as a trader. This is again lifted directly from my plan when I first wrote it. I have an edge that I'm confident in, and I have an extraordinary amount of discipline and patience to execute that edge. Individual wins and losses are not important. The most crucial factor is whether I make a good trade that conforms to my trading rules and which therefore has a high probability of working. If I continue to do this, I will win over time. My personal aim is to be the best that I can be. I will constantly compare what I did today with what I did yesterday. I'll do more of what works and less of what does not. I'll also study what does not work with a view to seeing if I can exploit opportunities to do the opposite and profit from it. I'll have no fear or hesitation and will trade with ruthless decisiveness and focus. By keeping to my trading plan, I'll achieve financial success and personal satisfaction. I first wrote this back in probably 2007, and I have never changed it. I wrote that when I first sat down, and that was what I considered to be my mission statement as a trader. And I used to read this before I traded because it was very important to get myself in the zone and remind myself that individual wins and losses are not important. I just have to conform to my trading rules, and I have to always focus on doing more of what works, less of what doesn't. It's like your statement as a trader to grow and to prosper in this career. And again, one of the things that I suffered with early on was procrastinating before I entered trades, being fearful before I entered trades. So I put down here very clearly, I will have no fear or hesitation. I know my edge, so I just need to execute it with ruthless decisiveness. So obviously you'd come up with your own mission statement, and it might be similar to mine, it might be nothing like mine, but it would be almost like a pep talk that you would give yourself before you sit down every day. So moving on from there, we now start to think about the type of trader that we are. Are you a systematic trader? If you're a systematic trader, are you an automated systematic trader? So you have a program execute for you, or are you a manual, discretionary trader? Are you an intraday trader, a swing trader, a position trader? So what kind of trader are you? And then the second part of this question is this style working for you? or if you're unsure yet whether it is or not, do you believe it can? And the reason I think that's important to just nail down at the beginning is so many traders end up merging styles. You've obviously heard that joke that often circulates on social media where somebody starts out as an intraday trader trying to scalp and ends up a fucking position trader because the trade goes so far against them. But there's a lot of truth in a joke like that, and I've seen it happen many times. So what kind of trader are you, and is it working for you? Some people find that being a discretionary trader is very, very difficult, and then they look for ways to maybe systematize things because they realize that that's easier on their psychology. So it's not so much what you are now, but what you'd also like to be, which is key here. So moving on, now we're looking at your edge over the next trader. This is absolutely critical. This is where you list all the strengths that separate you from your competition and how you think they will help you in your career. So here is where you come in and you think about, why are you actually better than the next guy or girl? And this again is lifted directly from my plan. This is why I believe I'm better than any other trader that executes my strategy. So first and foremost, I've done the work. I've collected the statistics. I've tested my edge under numerous market conditions. I know what I want to see, where I want to see it, and when I want to see it, and therefore have the confidence to execute without hesitation. So many people don't because they haven't done the work. They haven't got the history of knowing that it works. Secondly, I'm extremely process focused. I've drawn up flowcharts for each of my strategies. I've ingrained them in my memory. I'm a meticulous planner, and I'm prepared to spend a significant amount of my time diligently examining everything I've done, even examining myself absolutely ruthlessly, which again, a lot of people can't do. A lot of people take a loser, they realize that they acted perhaps impulsively, and they just want to brush it aside and not actually try and look deep into themselves, why they did these things, and come up with solutions to the problem, which again, I will leave no stone unturned in examining myself and trying to work out ways around problems. Point 3, I don't suffer from a fear of missing moves. Never have. So that means that I don't act out of FOMO, which can undo a lot of traders. Point 4, I am exceptionally patient. You've seen that during EFL. I'm not susceptible to acting impulsively out of boredom and taking low probability setups. And in environments that are not conducive to trading, I can sit on my hands for extended periods of time. And there's edge in that. But there's also real edge in point 5. I do not need to trade frequently. And that's because I'm trading significant capital. Now, that is an edge over a person that has a smaller account and that does need to trade frequently to make ends meet. You can see that I'm breaking it down here into the work that I've done and the experience I've got, which puts me ahead of the next person, but also the mindset that puts me ahead of the next person in terms of not being fearful and being patient, but then also the account size is putting me ahead of the next person. Again, back on mindset, point 6, I've got the mental ability to recover quickly from losses. They do not affect my subsequent decisions. Now, I get irritated by the outcome of trades sometimes, and I get frustrated, but honestly, I will take a walk around the block and I'm absolutely fine. I will not sit down though and trade again if anything is bothering me. And sometimes mentors say, well, things shouldn't bother you. You know, if you take a loss, it's not the end of the world. Just step up and take the next trade. But not all losses are the same. If you buy the market and it goes straight to your stop and stops you out, and then it carries on and goes another point lower, you think, okay, I got that wrong, but glad I got out of the way. Now imagine that you're calling the bottom in a market and you're expecting a major move, and it stops you out and goes one fucking tick lower and then goes absolutely vertical for the next 3 days. Still a loss, but one loss is considerably more frustrating than the next one. So not all losses are the same, and this is why it's really important for me to not let any loss, no matter how it transpires, affect my subsequent decisions. And I'm very good at doing that after all these years. And again, point 7, I have the discipline to commit to a plan of action. And if you take all of those 7 points, that is why I think that I am better than the next person that executes my strategy. So you want to do the same thing. You want to think about what are your strengths that separate you from the competition. The flip side of that is your weaknesses. What are your weaknesses? What are the points that you've got to work on? And you want to think about your weaknesses, and for each one you need to follow this process. Ask yourself, what is the weakness or the problem? Why do you have this weakness or problem? And what are you going to do about it? And so many people start with step 1, what is the problem, and then go on to step 3, what am I going to do about it, without considering step 2. If you don't know why you've got the problem, it's often very hard to solve it. An example of that is patience. Some people say, oh, I just feel like I've got no patience, that's the problem. So let's go on to step 3. What am I going to do about it? I'm just going to sit here and have more patience. Now, if you don't know why you've got the problem in the first place, you probably won't be able to fix it. So in the example of patience, a lot of people are impatient because they don't know exactly what they're waiting for. So any good advert will get them into the market. And as I've said before, the market's always constantly advertising. So if you're able to think, well, why have I got a problem with patience? And you really examine it and you think to yourself, I don't really know my edge inside out and back to front, so I'm jumping into things because I'm not really sure what is an A+ trade and what isn't, then how is being more patient going to solve the problem? It's not. What's going to solve the problem is actually working on your edge and understanding what makes a great trade. So again, point 2 is very important. These are some examples that I have taken from students that have put these in their own trading plans. So an example of a problem and how to solve it. The first problem, I take many unplanned trades. Why have you got this problem? Because I'm bored whilst waiting for the absolutely optimal opportunities. They don't come around very often. What are you going to do to resolve this problem? I'm going to give myself something to do to occupy my time whilst watching. This may be working on gathering statistics for a pattern I'm interested in. It might be filling in my trading journal and working out how I can improve my performance. But I'll give myself something to do. Interestingly enough, I find that traders I've worked with that have a job to do whilst they're trading often do better. Now, sometimes it does mean that they miss things, but on balance they tend to do better because they're occupied, they've got something to work on, that's taking their focus and their attention, that's paying their salary, and yet on the side they've got the charts and they're able to just wait for something to maneuver into the right position so they can execute on it. This second example was from a student. This was very close to home for me. But again, here the problem. I keep getting scared and cancelling orders based on gut instinct they won't work. And then I see them work perfectly. And the problem is, on those times I'm confident enough to keep an order in, it always seems like it goes straight to my stop. And I seem trapped in this situation of doing the wrong thing at the wrong time. So again, the question I asked them was, well, why do you have this problem? And their answer, which they came up with immediately, was, well, I don't record my cancelled trades. So I've got no way of knowing the potential outcome of having kept them all in. So what are you going to do to resolve this problem? The answer is, I'm going to spend time at the weekend recording my last 30 cancelled orders, and I'm going to categorically let the data tell me if there was edge over that sample size in having kept all those orders in. It's the only way you're going to know, because as I've said before, you can get caught up in recency bias, where you cancel an order and you think, the trade wouldn't have worked anyway. Good job I cancelled it. Then the next time you cancel an order, it works perfectly. You've seen on EFL, I've cancelled 2 orders. I cancelled the pound dollar because I didn't like the way price traded into it, and it worked perfectly. I also cancelled Bitcoin because of the way that price was trading into it and the R was diminishing, and that would have worked perfectly. So you've seen me cancel 2 orders that would have made money, but I know over the long run that it does pay me to cancel these orders. Do you? Does the average person that is putting in orders and then pulling them because they don't like the way price is trading into them know that that is the right thing to do? And a lot of people don't record missed trades. But here it's just, again, about looking at a weakness and saying, how am I going to combat this weakness? So moving on to the next part of the plan, commitment of funds. Have you planned your commitment of funds? You can think about the following questions. This is for very newer traders, but I mean even more experienced ones can fill this out. Are you going to begin your trading journey with a live or a demo account? If you choose demo, When are you going to feel confident enough to go live? How much are you going to initially fund your live trading account? Are you going to add to it if you begin to make money, or are you just going to grow the pot? Are there times when you won't trade? Now, some of you might think, oh man, these are so many questions to ask myself. Do I really need to consider all of these things? But this is going beyond trading and thinking of this actually as a business. If you're setting up a business, these questions are going to need to be considered. How much money are you putting into this business? If you need more money, where are you going to get it from? What would be your bottom line for adding money to your business, and so on and so forth? So I think these are good things to consider. Again, this was taken from a student. I will begin my trading journey with a live account funded with only $1,000. I do not intend to add to it as it grows. My aim is to build up a 6-month track record of profitability and then apply to the prop firm Tom is trading at. Now, I think that's a fair commitment. They're live. It's a small amount of money, but they said, I'm not going to add to this. I'm just going to grow it and see if I can then get back with some serious capital. This is actually taken from my personal trading plan. I will not trade during the month of July because we like to go on holiday every year, and I know from my data that July is historically the worst month of the year for my performance. Now, this year I actually did have a couple of trades in July, so it's not a blanket rule that I no longer trade Julys, but nearly every single year I've adhered to that rule. And even if I'm not adhering to it, I'm not actively sitting here watching the markets every single day. I'm essentially not trading in July, and if I do happen to glance at something and it looks really too good to miss, then I'll take that trade. But this was when I first wrote my trading plan, what I put in. And I think it's a good idea to know if there are periods that you won't trade. It doesn't necessarily have to be a month-long period. You might say, like we discussed earlier in the plan, how one student had said that they decided they weren't going to trade Mondays because it was just a day that either they had very few setups or they lost money on. And that's absolutely fine. Moving on to targets. You'll want to think about whether you're a person that works well with targets, and if so, what those targets will be. Not everyone will work well with a target. In prop, they used to give us financial targets to try and meet each day. I never agreed with financial targets. I think it encourages negative mindset. If you've got a target of, let's say, $1,000 a day, and you don't see anything that you like all day, you might be pressurized to trade. Or let's say that you've got a target of $2,000 a week, and you've made all that by Wednesday, you might think, right, I don't want to risk losing that, so now I'm not going to trade Thursday and Friday, and you might leave some great opportunities by not trading. So I'm not a fan of financial targets, but targets don't have to be financial. And I've listed some below, and also said here that you should also consider accountability for these targets. What happens if you don't meet them? And if you do meet them, how you might reward yourself. But these were the targets as I outlined them when I first wrote my trading plan. So I broke them down into daily, weekly and quarterly targets. The daily trading target, simply to execute my trading plan each day. Nothing more than that. But if at any point I break my rules, I will record it in my Demon Finder and take the rest of the day off and begin again tomorrow. So there is accountability there. All I've got to do is get through the trading day following my rules. But the moment I break a rule, that's it. I'm done. I've got to log it and I've got to walk away. And when I get back to my desk tomorrow, that big tick in the box in my Demon Finder is staring me in the face. The weekly trading target. I will commit to taking all trades that set up according to my plan. I will aim for a minimum of 2R return per week, but I will not stop if I reach it. So here I have got a loose financial target of 2R. That's what I'd like to achieve, but sometimes you might make that on a fucking Monday morning. You're not going to take the rest of the week off, and you don't want to be scared to keep trading. You have to push your edge if it's there. My weekly target was also to ensure all trades are entered into my trading journal. If this is not done on any given week, then I will not trade until it has been done. So for me, my rule was simply, when I get to the end of the week, all trades have to be logged in my trading journal before I can start trading again Monday. And if they're not logged, then I can't trade until they have been. So it encourages me to do it over the weekend. The quarterly trading targets are the big ones. So here I outlined 3 things. Number 1, I will find an effective way to cut losing trades a little quicker. Number 2, I will find an effective way to hold winning trades a little longer. Number 3, I will find a new edge based on the statistics I collect on markets. Now, if you can even do one of those things, let alone all three, your edge is going to be improving. If you're getting out of losers quicker, if you're holding winning trades longer, or if you're coming up with new edge, you are going to be improving. And that's why it's very important to me to have those targets every quarter. But to meet these quarterly trading targets, it requires me to meet my weekly goal of filling in trades into my journal and to make time, initially 60 minutes each day, to work on some statistics. So for example, when I wrote this back in the day, I was working on how often price revisits the Sunday open in the Eurodollar between Tuesday and Friday, which I've explained to you many times and you should be very familiar with by now. But again, you can see how these targets feed into one another. You need to execute your trading plan each day in order to get good trades. They will then go into your trading journal, and your trading journal will help you find a way to achieve one of these goals from your quarterly targets. So now we're moving into edge, actual edge in the market. What is your edge? So we start out by listing the markets that we trade. So again, here is where you want to list the markets that you trade, and you want to think of the following. Are you going to choose just one market to trade? Are you going to trade multiple markets? How did you make your choice of markets to trade? Have you got a sufficient monitoring system if you're looking at 10 different markets? And what happens if you hear or see an opportunity in a market that's not in your list? So what about if you say, I'm going to just trade the Forex majors and I'm going to trade a certain pattern in the Forex majors, and then somebody says to you, hey, you know that pattern you trade? Look at it over here in the NQ. It's the exact same pattern. Are you suddenly going into the NQ, or are you going to be like, no, the NQ is not my market? I think it's good to think of these things ahead of time. Again, here is a list for those that have asked of all the markets that I trade. So these are the spot FX pairs, these are the commodities, the equity indices, and of course BTC. Now, I made more rules when I wrote my plan. So here's what I wrote. I do not actively look at any other markets than those listed. However, during times of extremely limited opportunities, I may decide to do so. I am prepared to trade opportunities in other markets, but I will not take a trade in any market before ensuring that I can answer these 4 questions. I know the exchange and broker open closing times. I know that the spread is less than 5% of ATR, because you don't want to get killed on spreads, and some of them are unreasonably wide in markets with low ATRs. I understand the increments that the market moves in, because obviously that helps with position sizing, and I understand the margin requirements. I have in my past seen setups in other markets, jumped into them and not been aware of these things and made big mistakes. I remember a time many years ago that I jumped into a market and I wasn't aware of the increments that the market moved in, so I ended up massively overbetting on the trade. And as soon as I clicked enter into the trade and was filled, I looked at my P&L, how much I was down just on the spread, and I nearly had a fucking heart attack. It was just poor prep. Just like, oh, there's this market, there's a pattern in it, and in I go. So that is why this was built into my trading rules. And this is another thing to think about when you're writing a plan, that you won't write the perfect plan from day one. A plan will need to be visited fairly frequently. I'd say once a month you go back and you skim over your plan and you say, is there something that I need to change? And that's how you progress over time. So again, this didn't start out in my plan. All that started out in my plan was this line up here. I'll trade any other markets if there's limited opportunities, and then I do my conkers over betting, and this goes in the plan here. So it's always developing to make you a better trader and to make sure you don't get caught out again in the future. Next, you list the tools of the trade. You're going to list your broker. Are you satisfied with your broker? Something to think about. Your charting, your news feeds, any other services you use, and any associated costs. Why do you want to list the costs of things? Because it's a business. You want to know what your outgoings are because you've got to fucking beat them on your incomings on your trading. It's really all about treating trading as a business. Timeframes. What timeframes will you be trading? So here's an example from my plan for the swing strategy. Of course, you know by now I use weekly and daily timeframes to determine if there's a higher timeframe bias. I use hourly charts to enter trades and manage them. And that's it. But if, however, you want to take things one step further and say I use hourly charts and then I use 5 minutes to enter and manage trades, that's fine. One thing I see people doing a lot of is using a huge number of time frames and getting super confused. So again, something to think about from your own trading. We move on now to risk. So it's position sizing and risk management. Now there's a lot of questions to ask yourself here, but again, curiosity is the foundation for having a rock solid plan and constantly improving. So asking yourself questions all the time and coming up with answers. And again, the answer doesn't have to be set in stone. You may decide to start out with one line of thinking and then develop it over time. But what is that initial point that you're starting out with? So here we're considering these questions. What is your risk per trade going to be? What is your risk per day going to be? What happens if you hit that risk? Are you taking the rest of the day off, or are you just going to sit there and watch markets but have the discipline not to trade? Do you have an upside target? Do you have a point at which if you've made this much money in a day, that's it for the day? What is your correlated risk? And by that I mean, if you're like me trading multiple markets, are you prepared to trade a lot of markets that are correlated at the same time and perhaps increase your risk of being very much skewed one direction? So as an example, let's say you're trading the indices and you get a buy setup and it's there in the ES, the NQ, the Dow. Are you taking all of them? Or are you just going to say, I'm going to trade one? How are you dealing with that situation? You might want to split your risk among all three. You might want to just decide to trade one. If you decide to trade one, how do you decide which one to trade? These are all things you should think about. Are you willing to hold overnight, over the weekends? Have you got any additional rules here? Another important one, which you really want to think about if you've got several different strategies, is are you allocating risk according to the expectancies of individual strategies? So if you have two strategies and you're starting to see in the data that one performs so much better than the other, are you going to allocate more risk to the particularly well-performing strategy? Or are you just going to keep risk constant? Will you ever scale up risk in good periods or scale it down in bad periods? If you have a loser, do you want to reduce risk? What about if you have 3 losers in a row? Do you want to reduce risk? The same, of course, applies on the flip side with winners. If you've had 3 winners in a row, do you want to increase your risk? Have you got a contingency plan for if your broker goes down? I've had it happen to me before, something to think about. At least I have a phone number jotted down. And at what point would you consider a strategy does not work? Which I think is always important when you're learning a new strategy. Is there a point at which you are down where you think this is not for me anymore? But also aligned with that is, have you made a fair go of it? If you look at a strategy and it hasn't been performing well, can you look over your trades and genuinely say, I understand this strategy and I haven't broken the rules, I've applied myself to it and it just doesn't work for me? Then that's the time at which you might want to move on. So it helps to think of that over time. These are lifted from my plan, my answers to these questions. So the risk per trade, I risk a maximum of 2% my total account per trade on the swing strategy. I risk a maximum of 4% per day. If I'm down 2R, I'm done for the day. And that 4% risk is not allowed to be made up of correlated positions which are held at the same time. So I won't take trades in markets that are correlated. I'll just take one position. If I hit a risk limit, there'll be no more trading for the rest of the day. If I drop a total of 10R from peak equity, regardless of time, I'll stop trading for 1 full week. The first day will be spent reviewing the trades carefully and comparing these to my plan and previous trades in my journal to try and isolate potential issues why I'm down so much. Once I've concluded my findings, the remaining 6 days rest will allow me to mentally reset. Now, I've only ever dropped more than 10R once in my career, and I didn't have a plan for it when I did. And that's why you're seeing it in my plan. It's never happened since I've had this in my plan, but the moment it happened, I had to think, well, what now? And then I deal with it in the moment, and then it goes into my plan, because if it's happened once, it might happen again, and next time you're going to know what to do with it. I think it's very important, if you're losing money, to do two things. Remove yourself from the market and try and work out why. I personally have no upside targets on the day or week. I am prepared to hold trades overnight, but not over the weekend. And I don't scale up risk during good periods or scale down during bad periods. I keep the level of risk constant. Now, I haven't gone into allocating risk according to the expectancies of individual strategies, because that won't make a lot of sense to you, because we haven't covered all the strategies I trade. But that is, again, as I said before, something you want to consider. Moving on from there, general money management. You want to think about the following questions. How much capital are you willing to keep in your trading account? All of it or just a percentage? How often are you going to withdraw? And when will you pay yourself? And if you're not withdrawing, why and for how long? So this, again, lifted from my plan when I first wrote it. I'll only keep 10% of my total trading funds with my broker. Why would I do that? The reason is because there's a lot of risk when you've got money with a broker that it might go under. I would rather have my money in a bank account. And there's no need to have it with the broker because they offer leverage. So there's absolutely no need to keep your money with a broker. So the way I set up my trading business initially was I'll only keep 10% of my total trading funds in my broker. I'll keep the rest in an instant access savings account. This will be adjusted on the last trading day of every month, unless losses deem it necessary to adjust sooner. So what that means is, if I've got, let's say, 10,000 and I'm putting only 1,000, which is 10%, into the trading account, if I'm risking 2% a trade, which is £200, if I get 5 trades wrong, I'm going to have to top the account up. So this is why I say this will be adjusted only on the last trading day of every month, unless losses deem it necessary to adjust sooner. By the way, the strategy that I'm explaining here is not really conducive to building a track record. It's conducive to running a business because you don't want to have financial risk by keeping your money with a broker. But it's not conducive to building a track record because your risk looks inflated because people don't know how much you've got in your bank account. So again, going back to the example I've just given you, if I know my trading pot is 10,000, but I only fund the account with 1,000 and I start trading it, although I know I'm only taking 2% risk, to anyone that looks at the statements, if I want to build a track record, it's going to look like I've taken 20% risk. So you can see that that wouldn't really work if you're building a track record. But if you're not, then I think it's a good idea. Again, I withdraw 90% of my profit on the last trading day of every month from my broker to my savings account. And on the last trading day of the month, I withdraw my salary to my general bank account. This is regardless of my performance on any given month. Once I've done this, I set my risk levels accordingly. So I always pay myself. Now, I put just a little example here of how this works in practice. So imagine you're willing to invest, again, 10,000. You deposit 1,000 to the broker, leaving 9,000 in your savings. Your risk is set at 200 for the first trade because that's 2% of the total amount that you're investing. At the end of month 1, assume you've made a 20% return on capital, and of the 10,000 you've decided to allocate to trading, you've made 2,000 profit. Then I would withdraw 1,800 to savings. Your savings has now got 10,800, the broker's got 1,200. And then I would pay myself 1,000, which would not be a salary, but it'd be a stipend really, from my savings account. The savings would now have 9,800, the broker would have 1,200, and the risk would be set at 220, which is 2% of your 11,000 trading capital. That's the best position to be in because you're paying yourself a wage and the account balance is increasing. Now I know some of you might be totally lost at this point, but you'll be able to read back through this and just essentially see a very basic example of how I would do it with a small pot. I have seen a lot of brokerages go under. A lot of people lose their money. In the crypto world, you saw FTX, but even before I even got into crypto, I saw many brokerages that I'd invested money with go under and just disappear overnight. And so ultimately, I've always considered that you're safer to have your money with a bank, and that's why you use the leverage that the broker provides you. Sometimes I say to people, I've got 500 to 1 leverage, and they say, what the fuck, that's ridiculous, that's irresponsible. No, that's called good risk management if you're not a cunt. You know, if you're a cunt, you'll use that 500 to 1 to go balls deep and start steaming into trades. But you should be using the 500 to 1 to think, that's amazing, I can keep my money in a fucking safe bank account and haven't got to give it all to this brokerage. Some people are saying maybe your broker is insured, maybe you'll get the money back. Yes, maybe. But then again, something else to think about is how quickly are you going to get that money back? For me, it's just a safety net. So moving on to strategies now. Here's where you describe your strategies and the rules for each of them in as much detail as possible. So the questions to ask yourself here are, where do you enter your trades? Where do you place your stops? Where do you place your targets? Is there a minimum risk-reward ratio that you would accept? Are there certain times of day that you don't trade? How do you manage trades? Do you trail a stop, or do you use no intervention at all? Are you scaling in or out? Will you add to trades? If so, under what conditions? If the trade's moving against you, do you ever get out before your stop is hit? What do you do if a trade hits target but you're not filled? When you've detailed your strategy, you need to try and think if there are any rules that you need to be aware of. Like, for example, what would keep you out of taking a trade that looks like it fits your rules? And then consider creating a flow diagram that gives you a visual way to show your setup, which we will go on to shortly. So what I've done here is I've given you an example from my playbook of the euro-dollar weekly open strategy, and you'll see how detailed I've been when writing it down in my plan. So I started out with the idea behind the trade. Simple, the pair will revert back to the weekly open price between Tuesday and Friday. Next, very important to consider, how do I know this? Some cunt said it on YouTube. How do I actually know that this is actually going to revert back to the weekly open price between Tuesday to Friday? Because I've back tested it. I know the past probabilities of this occurring. So now it's just a question of, well, how do I get into this trade? So the day of entry is between Tuesday to Friday, as long as it's not already tested the weekly open. The time frame of entry is the hourly. Before I can enter the market, I have to have mapped out my key levels. They're on the weekly, the daily, and the hourly. I like to consider key Fibonacci levels drawn from daily swing points. I know where upside and downside ATR levels are, and I like to note any H1 rejection candles, which are hammers or shooting stars. As you've seen, I use them quite a lot in my trading. And I know that price may react from them, so I want to know where they come in. Now, I'm not going to read all of this because I'm going to be hoarse by the end of this if I do. But you can read it either now or when you go through the recording. But here I have detailed the setup. This is exactly what I'm looking for, like I'm writing a manual for someone that hasn't traded it before. Now that's going to be quite hard to do because I know my edge inside out and back to front, so I'm not really assuming that the person reading it will know absolutely nothing. So it's not that basic, but you'll be able to see. Essentially, if looking to trade long, I'm prepared to bid at old highs below market or the head of an H1 hammer. If I'm looking to trade short, I'm prepared to offer at old lows above market on the H1 or the low of an H1 shooting star. And I'm going through and I'm writing down how I'm getting in. I'm using a limit order. What am I looking for? I'm only entering the order when I know that price will make a rounded retest. What the fuck is a rounded retest? It's this. The level I'm trading must also be naked. What the hell does that mean? It means this. Where exactly am I getting in? I'm getting in there. The last high pre-break for long, the last low pre-break for short, or the high of a hammer or the low of a shooting star. Where's my stop going on these trades? I'll use a stop behind the thrust candle that broke and closed through the level. Well, will I always? No, because if that stop stops me out into a zone, then I'll need to move the stop back to the next thrust candle. If I'm not using a level to enter and I'm using a hammer or a shooting star, the stop goes beyond the extreme. See, I'm trying to account for every contingency. Then alternative entries. Well, if I see price action occurring at or ahead of the level I intend to trade, then I can use that price action to enter the trade. It may be to get into a trade I've missed, or it might be to even add to a trade. These are the candles that I consider and what they look like. Here's how I enter them. This I'm not going to go through, you can read it. We haven't talked a lot about SFPs in the course, and we certainly haven't talked about conservative entries for them, which is how I managed to find a lot of success trading SFPs where other people don't. This conservative entry is very powerful for me, and it's when I see an SFP and I wait for more confirmation before taking it. It's a little bit like seeing a hammer and waiting for the thrust candle and then bidding the return to the hammer high. But you can read that in your own time. Then we go on to trade management. Well, the target for this trade will be the weekly open price. But how am I managing this trade? I'm trailing stops below thrust candles. What is a thrust candle? Moving forward, I'll keep trailing the stop in this way until either the stop or the target is hit. Here we skip forwards to what happens if I'm trapped on the wrong side of a level. Then I take an early exit. Here's the evolving R that I'm mindful of during the trade. Here's what happens if I see my trade hit target but I'm not filled. I have to exit immediately. See, what I'm trying to do is cover every possible variable, and you probably won't be able to, because at some point something's going to happen that you haven't planned for, and that's great because you just make a decision in the moment and then you go back and put it in your plan for next time. Here's my rules for standing aside from trades. So this is what you've seen me do before ahead of news. I've been a little bit scientific here, less so than I have been on EFL, but people often ask me, how close to the level does the market have to be for you to pull an order ahead of news? And generally, it's within 20% of ATR. So let's say that your ATR on a pair is 80 pips. 20% of 80 would be 16. So if we're trading within 16 pips from the level, I'm almost certainly going to pull it. Now, in reality, a lot of the time I pull orders anyway, but that's like the minimum rule that I first wrote down in my plan because I wanted to give myself a specific frame of reference. You don't want to have an order in, then the news is coming out in 5 minutes and you haven't got a fucking clue what to do. So I would go back to my plan in those circumstances and say, right, this is what I'm going to do this time. This is what I wrote in my plan. Let's see how that works out. Maybe the first time you write in this rule about pulling it only if it's within 20% of ATR, that still means that you get caught out on a trade that fills you and goes straight to stop and you get slipped. And then you go, right, fuck that, 20%, I need to increase that to 50%. And the plan develops. But you should always have a starting point and develop it from there. This is what happens if a trade comes close to an entry and then moves over halfway to my target. I usually cancel the order and don't get in again if it pulls back. And again, I've tried to be a little scientific here. If it gets close enough to be within 10% of ATR on my level, so if the ATR of the market's 50 and we're 5 pips from my level and then go halfway to target, that order's being pulled. Then I've got my rules for adding to a trade. So I add in 2 different circumstances. If I feel that the probabilities of a successful move have increased, but the market is still trading close to the original entry. And you need to just kind of imagine this because I haven't got a chart example to show you. But let's say that you're looking to buy a level, you get filled, and then you get an inside candle, so you're a little in profit. Then the next hourly candle starts, and it now goes offside, but by the end of the hour, you've got inside hour failure and a hammer occurring after you're long the market. You might be able to add to that trade even though price is still only slightly higher than where you initially got in. It hasn't really gone anywhere, but you now feel that the probability of the successful trade is increasing. Primarily when I add though, it's when I'm in a position that I'm running and there are levels on the hourly that the market breaks. And that, again, I've said very clearly here, they have to be levels that I would ordinarily trade at. So I have to ask myself the question, if I wasn't in this trade, would I get in here? And if the answer's no, then I'm not adding. I'm very regimented with that. And here I've got my specific rules for adding in terms of risk. And this is just the way I do things. It's not necessarily the right way, but I will add into the trade the risk that has been reduced by the stop movement back to the original risk taken at the trade outset. So what I mean by that is, let's say I've taken 2% risk and I'm now in a trade and I'm up 4%. Then I would be willing to take enough of a position at that second addition point that if I lose, I will lose all of the 4% that I've made and the original 2%. That's when I really feel I've got the market by the balls, because it's quite aggressive. So I'd be giving back all my profit and still take the same size loss that I'd originally planned on the trade idea. Here I've outlined that in some cases the risk taken may be more than the percentage that I'm allowed to risk on a trade, but the risk incurred after adding may never be greater than the risk at trade outset. So what I mean by that is, again, if I'm massively up on a trade, then if I'm prepared to give all that back and go back to the original trade risk that I had at outset, the second edition might have a much higher trade risk than 2%. But that's okay, as long as I feel that I can't lose more than the 2% on the original trade idea. So it is aggressive, but that's the way I do things. And I don't always do that when I'm adding, but that's when I really feel I've got this market by the balls. That's what I tried to do on BTC, by the way, when it closed as an inside day failure. That's how I tried to add, in that exact same way. And again, before taking the trade, I consider, number one, does it fit my plan perfectly? Number two, does it present an absolute minimum reward to risk of 1-to-1? And then number three, I've got a rule that I've stuck to over the years, which is no trade, no matter how enticing the level, must be taken in the direction of the prevailing trend of day if the market surpassed its ATR on the day. So what does that mean? It means if we're heading up and we're above upside ATR, I'm not buying. I'm only fading momentum. So I'm only taking a mean reversion trade. But there's a caveat. Of course, there has to be a caveat, because if you're trading long enough, you see something and you go, what the fuck? If a terrorist attack goes off and bonds are going through the roof and equities are plummeting, you're surely not going to sit there and go, oh, well, I can't get short the S&P 500, even though the president's just been assassinated and the fucking White House has just blown up, because we're past downside ATR. So, obviously, you have to know when to break the rules. I think it was Ed Seykota, actually, in Market Wizards that said, follow the rules, follow the rules, follow the rules, know when to break the rules. Which I think is brilliant. So we're coming near to the end of the plan now. What's your daily routine? Write down the routine you'll go through before you begin trading each day, so that you prep in a way that is conducive to maximizing your performance, catching all the opportunities, being fully appraised of what's happening, what risk is coming out on the given day. So consider, do you check the calendar and note down times you might need to pull orders? Do you read any overnight news to see what traders are focusing on, or maybe you couldn't care at all? Do you note down the trades you're prepared to take in an Excel sheet so that you can look back and have some accountability at end of day, or are you just going to try and commit everything to memory? Here's an example of my day. This is pretty much exactly how I've always done things and how I still do things. So just to run through very quickly now. 6 to 6:30 in the morning, I'm aware of the overnight action in the major markets, and I'm aware of the news that's scheduled for release that day. 6:30 to 7, I build a short list of markets with the closest opportunities and start to place orders. Always remember this before I trade. Take a few minutes to focus before I sit and begin trading. Trade confidently. Be patient and wait for the market to come to me, and if anything interferes with my focus, stop trading. Between 7 to 10, I'm watching the market action closely, and I remain very focused throughout the trading day. I have a break from 10 to 11. Usually I go for a walk, have something to eat. 11 to 12 I usually do statistics. I try and get some statistics done every day. 12 to 1 more free time. Then you've got key event risk usually at 1:30. So 1 to 4:30 I'm watching the market action, making sure I correctly manage any open positions. And then we move on to the aftermarket routine. So what's the routine you go through after you finish trading for each day? What time are you logging your trades? Maybe you're doing them after each trade, maybe you're doing them at the end of the day. Are you going to analyze your trades along with logging them, or are you just going to log them? And are you going to have any time to assess what's happening tomorrow during the day? So again, for me, 5 till 6 o'clock, I fill in Edgewonk, put the trades into my journal, and complete the daily plan that I've shown you during our live sessions. And I also complete the Demon Finder if it's relevant, which it almost never is. I cannot remember the last time I put anything in the Demon Finder, but you might if you're a newer trader. And then these are some questions I just think about after I've exited a trade. After a winning trade, did I trade according to my plan? Could I have extracted more profit? And after a losing trade, I asked myself, did I trade according to my plan again? Was there anything that could have allowed me to get out of the trade quicker? But most importantly, am I calm and relaxed and ready to enter the market on my next trade with an unemotional and professional attitude? And then 6 till 9 free time. And then 9 till 10, usually I check every market that I trade for a higher time frame bias. And if they're present, I start prepping a plan of action for the following day and maybe put in or adjust any orders for overnight action. So it's quite important to me to do that because some of my nicest trades set up overnight, and I can't count the number of missed opportunities I've had because I've slacked on that bit of analysis. So the 9 till 10 section is one of the most important parts of the day because it just allows me to start thinking about how are these day closes shaping up, what might I need to do overnight, if there doesn't look like there's anything I need to do overnight, what might I need to do very early on in the morning. One of our very last sessions, we were talking about bunds and saying there was inside day failure, and again it was a question of that night come in and see, right, we are closing as inside day failure. I don't want to leave an order in overnight, but I have fucking got to be at my desk at 7 a.m. because if that spikes up to the level, I want to be short. Now, as Sod's Law would have it, it didn't spike up to the level. The fucking thing went to target without me, but that's okay. You've got a plan, and you know the point of the evening session is just to be prepped for the next day. And then finally, we're on to the weekly routine. What tasks will you complete each week to improve? And think about when you'll do these. So for me, the main task I do these days is spend 2 hours on a Saturday between 10 till 12 conducting the weekly review. I've posted this to Twitter before, so we won't go over it again, but these are all the questions that I tend to ask myself. And my weekly review doesn't really take that long on the swing strategy because I don't have a huge number of trades. Often can take longer on the bund, but I tend to always ask myself these same questions, and sometimes you come up with additional questions as well. And the very final page of this trading plan is discipline. What are the consequences of breaking any part of your plan? And the example I've given here is again one from my own plan when I first wrote it. If I break one of the rules detailed in this trading plan, I will go over this thoroughly in my next period of free time. I'll focus on the reason why the rule was broken and what the outcome was. And if the experience is considered negative, I won't trade again until I've come up with a solution to prevent me breaking this rule in future. Now, why do I put if the experience is negative? Surely breaking a rule in your plan is negative, right? Well, no, not necessarily. Just like breaking a rule in your trading is not always negative. Sometimes you get rewarded for doing the wrong thing. You might break a rule in your plan and actually nothing negative occurs and something good happens from it. But if I have broken a rule, I need to consider it. If I've broken it and actually some good came of it, then I need to think, well, do I need this fucking rule in the first place in my trading plan? But if I had a rule in there and I broke it and a negative reaction occurred, then I need to think very closely about that. And again, come up with solutions. It's not just about berating yourself. It's about thinking, how can I make sure that I improve in future? So again, just to finally go over those 3 questions that you should ask yourself. What is the problem? Why have you got it? What can you do about it? That's a complete trading and business plan template. You should try to think about these questions to come up with your own written plan that you can build on over time. But if we go back to the strategy, again, what I've done here is I've only broken down one of the very many strategies that I use. But what you'll see here is I wrote, also consider creating a flow diagram that describes all your rules considering different scenarios. And the flow chart is my attempt to map out this text for a very specific strategy, and that really helps with fast forecasting. So let me bring a flow chart onto the screen as an example. So this is a flow chart that maps out my process for trading one strategy, one setup, which is the euro-dollar weekly open strategy. Now, you can use Miro.com to make your own. It's completely free to do it, and it's a great resource. And the idea of mapping out your strategy is very, very beneficial because it allows you to think about what you're doing very carefully. It gets you to think about what you want to see, where you want to see it, when you want to see it, and also what you don't want to see. Now, I am going to zoom in a minute, but two things I would say at the outset. First, I know some of you with OCD might be freaking out here thinking, what the fuck, man, this last decision box is not in the middle and this bit looks really low down. Listen, I'm a trader, not a fucking graphic designer. Secondly, I don't obviously look at these when I trade. I have got all of this in my head, but I mapped it all out for my strategies originally. So I have one of these for every strategy that I trade. But essentially, if I zoom in here, you will see this is just a series of questions to ask yourself, and depending on your answer, it gives you a solution of what to do next. So now when we rock up every day, not only have we got a clear business plan for our trading, but we have a flowchart for all of our setups that has been clearly defined, that over time we will be able to commit to our head for fast forecasting when we're in a trade. This will obviously translate into your daily planner, which you've seen me use several times before, that I'm just going to bring onto the screen here. So using this, we make a plan for each day that we come into the market and for each market that we trade. As I've said before, one of the ways I keep on top of so many markets is by color coding the tabs at the bottom. So I think you'll see that in one of the recordings I posted to the website. But if it's red, I know I've got a potential sell opportunity coming up. If it's green, I've got a potential buy opportunity coming up. If it's orange, I know there's opportunities potentially arising on both sides of the market, and if it's white, I know there's nothing to do. But I fill this in for every market. It really doesn't take long, because once, for example, you've filled in the day, date and calendar for one market, you can just cut and paste that into the others, and all you've really got to consider filling in is your biases and what you're looking at doing. Even the trades taken, you're probably not going to get trades in all your markets, so you won't need to fill in that. And this section down here regarding what happened today and your conclusions are probably going to be market specific. So it doesn't really take too long to do this, but it's an essential step in the process. Now let's move that off the screen for a minute. And what I want to do here is take this flow chart and put it there. And then I'm going to take the euro dollar chart and put it on the right. And this is how the euro dollar looked Tuesday morning. So let's follow this through to see the last trade that I took. So, is it Tuesday? Yes, it's Tuesday. Great, I can move on. Has the weekly open been tagged post the Monday close? No, the weekly open's up there and it hasn't been tagged, so I can move on. Where is the weekly open? Is it below or above current market price? It's above the current market price. So the next step, is there a level of old highs to bid below market that have been untested on the hourly time frame? Now you're probably going to draw your attention to these old highs, so you're already thinking yes, but this isn't a great area of old highs. Usually when I talk about old highs, I mean a pretty significant level that we've reacted from several times. So I would consider that that's actually no, because it's not a grey area. Is there an H1 hammer below market? Yes, there is. It's there. So this is getting interesting. Let's zoom in on that. Has that got a long lower wick relative to the candles around it? Yes, it has. Has it got a small to non-existent upper wick? Yes. Has it got a small body? Yes. Is both upper wick and body less than 1/3 of the range of the candle? Yes. The close must be above the prior candle low. It is. So I've seen the hammer. It fits the criteria for a hammer. I'm answering yes. The next question. Are you able to achieve an R of at least 1-to-1 if taking the trade at the high of the hammer with a stop beyond the low and a target of the weekly open price? Well, I think I can, but hey, we might want to pull up our trading view tool and just double check. So if I buy it there and I put my stop underneath that low and my target, yeah, comfortably over 1-to-1 R. So I can answer yes to that. Great. Place a bid at the high of the hammer with a stop below its low and a target of the weekly open price. Nice and simple. I know exactly what to do. I've been through this flow chart. I know exactly what to do. I've just got to place a bid and then follow the line. So we're going over here now. We're going all the way here and we're up to this point. Wait for a fill. Okay, cool. Let's wait for a fill. Market's coming back. I'm still waiting for my fill. Oh, fuck me, what's that? Are you filled? No, I have missed the fill. Okay, well, has price turned just ahead of your entry and formed the price action candle that can get you into the trade with an acceptable R? Is it a hammer, shooting star, bullish engulfing, bearish engulfing, etc.? Yes, that's exactly what's happened. Price has turned just ahead of my entry. It's formed the price action candle that can get me into the trade. The R is still acceptable. Imagine I enter here, stop even under there, it would still be over a 1R. But if I had, say, the stop there, yeah, that would be a 3.4R, even a bigger R than I originally had on the trade. Yes, yes, yes. The answer is definitely yes to that. Enter using this candle with a stop entry as it breaks the high, or the low, but it's the high because it's a hammer, and a stop below its extreme or below the level you originally planned to enter at. Discretion needed here. So either you're entering with a stop underneath this low or underneath the level you originally planned to enter at. Remember, I planned to enter it here, so I used the stop underneath that because even though I can see the price reacting and forming another hammer, it's not the longest rejection wick in the world, and I'm still trying to play this carefully in case it comes down for one more test of this original high that I was bid at. Then we move on to this. Trail stops below H1 thrust candles that break key structure. Okay, let's see. Do we get any? Oh, it's gone through the high, but it didn't break and close above the high. Now, here's a really important part. Because I've been doing this for so long, I've put candles that break key structure. What I haven't put there is break and close above key structure. And this is what you'll do when you are building your own map. Something will happen and you'll think, I need to be more specific. It's not just a break through it, it's a close through it. So trail stops below H1 thrust candles that break and close above key structure. Keep trailing the stop in this way until either the stop or the target is hit. Do not take any partials because we know where that thing is going. We've got the stats. Add to this trade if another setup presents itself. We don't have to worry about the trade going offside. It hasn't gone offside. And we've also got to keep our eye on the evolving R. If it's less than 0.2, I need to get out immediately. And if the trade hits target but I'm not filled, I need to get out immediately. Let's play it forward. It's pulled back. According to my rules here that are clearly outlined, there is nothing to do here. So we carry on and we hit target. And the trade's done. And then we're on to our final step, which is journal the trade once complete whilst waiting for the next setup. Now, you can watch the recording of this execution. It's on the website, so you can see exactly what I went through. But just to go back to the flow chart for a minute, lots of other things could have occurred here. And this flow chart isn't even fully complete. I've actually simplified it for you guys by just cutting off some of the decisions. So for example, if you follow this branch, where is the weekly open? Let's say the weekly open again is above market price. You want to get long. You can see a level of highs below market. Is there space? Let's say you answer yes to that. There is space between the break and retest. Is there a clear thrust candle that opened below and closed above the level? I've said if no, no trade. In actual fact, if the answer is no, what I tend to do is look for another thrust candle further back that I could use as long as the R is still good. So I have simplified it a little bit more. Now, just to go over that point, let me draw you a little example of what I'm talking about here with good old Paint Shop Pro. Let's say you've got something like this. You've got a level, and then you've got another level like that, and the market's broken up and it's coming back to this level. So what I was saying is, what you really want is to buy this level. This is the level where you anticipate the reaction. You need a thrust candle that goes through that. If you haven't got a clear thrust candle that goes through that, then what I'd probably do is go, well, is there one that went through this? Oh yes, there was here. Great. That will still offer an acceptable R. But in the flowchart, I've cut that out. Otherwise, it would be absolute chaos for you. And I also haven't included SFPs in the price action. I've just done hammers and shooting stars. So there is a lot more that you can add to this, and it's already this big. Now, just zooming out for a second, you can move this around. Miro's a really good tool to do these mind maps with, by the way. But if you go back and you look at the video, something should strike you, and I've taken a screenshot from the video just as the trade was about to hit target. Have a look at what I've written on my plan. It looks so simple. Bullish reaction from the high of the hammer on the weekly, great. Bullish on the daily because of the stats for the return to the weekly open, and I'm just going to buy a pullback to the head of the hourly hammer. It looks really, really simple. And then the developments, oh, I missed it, so I've got to buy the next hammer that formed. That looks so simple, but now look at the flowchart of decision making that's involved there. You can see all of this shit that could happen and what I'm going to do in relation to all these different variables when the market is moving. What you saw on that day is what happened, so you don't see all the other things that might have happened that I've had to prepare for ahead of time. Whatever that market was going to throw at me, I knew what to do, and that's because I've prepped it out ahead of time. So it's a very, very useful exercise, because as you're doing it, you start thinking about things and you start asking yourself questions of, what do I do if I see this? What do I do if I see that? It does take some time, but well worth doing. And again, free to do with Miro, super simple. So we've gone from a business plan to a flowchart. We've gone from a flowchart to daily prep, which takes us into a trade. When the trade's concluded, we're going to consider whether there are any key mistakes we made. And if there were any key mistakes, they are going into the Demon Finder. That's of critical importance. It's the best way of tracking mistakes. And I keep a copy of that printed out on my desk in front of me at all times. Mine is completely blank at the moment, and it has been blank for a long time, but I always keep it in front of me because it reminds me that I can make mistakes. I'm only human, and if I do make a mistake, I want to see it right in front of me when I get back to my desk the next day. As I'm so fond of saying, I think what's kept me from getting complacent over the years when I've had very good win streaks is always reminding myself that I'm one step away from acting like a cunt, rather than trying to think that I'm one step away from being someone special. And I think if more people think like that, it just keeps those emotions in check, which might lead you to do things that you'll regret. Being super confident because you've had a few winners and massively sizing up and all these kinds of things that people do. So invaluable for me over the years. So again, we're going to log any mistakes that we make in the Demon Finder, and from there we're going to enter our trades into our trading journal. So this is Edgewonk. This Edgewonk has been set up to log only the trades that I took on the swing strategy during EFL. I haven't utilised this Edgewonk in the full way it should be, So right now I've only made some basic entries, but we'll cover them and I'll point a few things out to you. I started the journal with a theoretical balance of 50,000. Why 50,000? Because it's the amount that Rain are initially looking to back profitable traders with. So I plucked that number out as a number that people might look to start an account with, but it really wouldn't matter whether it's 5,000, whatever. And I used 2% risk for every trade, which is the standard amount that I risk on my swing strategy. But I do trade with different brokers. So for example, I don't put my BTC trades through CMC, which is the platform that you saw me using during EFL. Essentially, different brokers means different fills. So I've only reported the fills with CMC. And sometimes you'll see a lower R in the recorded trade here in Edgewonk than you'll remember me saying. The BTC trade that I put in got only a 3.7R using CMC's pricing. So I've tried to standardize everything to one broker, otherwise I could have just used the best fills, but everything was put through with CMC. So you will notice a little drop in the R compared to some of the things I perhaps reported originally due to those wider spreads and different fills. So essentially I'm underreporting here. But with that aside, the total result trading a 50k account over the month at 2% risk per trade would have been, and I say would have been because I'm not trading a 50k account, I'm trading considerably larger than that. But if you had been trading a 50k account, taken these trades at 2% risk, all with CMC, you would have had a closing balance of 60,516.60. So just over 10k profit or 21% return, taking only 9 trades across 6 trading days of the month and achieving 9.82R. Now, as I said before, is it normal to take 9 trades in a month? No. I had a lot of other commitments this month. It is what it is. But one thing you'll find is that when you haven't got a large sample size, which I don't have here, some of the returns you can get fall outside what they would be usually. So I can tell you from my trading over the years, this strike rate of 66.67 is low. If we now had 100 trades in here, you would see that my strike rate would increase, but this would decrease here, which is the average winner versus average loser. If you look at that in pounds, the average loser was 468.24, the average winner was 1,986.89. So that's making the average winner 4.24 times the average loser. There's no way I'm anywhere near that in the long run. But again, this is a very low frequency of trades. But I just thought I'd show you a few ways you can use a journal like this. And please bear in mind that 9 trades is not statistically significant of anything. So you can't take anything away from this other than a showcase of Edgewonk and perhaps some ideas to consider in your own trading. But just as a brief look at the calendar, this was every trade that was taken. Just again, on the swing strategy, I have a separate Edgewonk that I use for bund trading. This is the monetary value of the trades, but you can look at them in R multiple as well. So if we have a look at a few things down the side here, I'll just open up some of the tabs. So let's maybe start out by looking at the equity graph. That's my equity curve. That obviously shows you stats like your biggest winner in R, 3.7, biggest loser in R, 1, total R over the period, 9.82, and obviously over time you start to see your equity curve build out. If we go to the drawdown, under here you'll see what your peak to trough drawdown is. My max in this month was 2%. So relative to the 21% return achieved from risking 2% risk a trade, it's pretty good. Obviously it looks pretty dramatic here because we don't have enough data, but 2% was the max drawdown on the swing strategy. If we go to efficiency, you'll see my efficiency is running at 100% because I almost never make mistakes. So when you place a trade in Edgewonk, you can add in an entry of whether you believe that you've made a mistake, so you can add comments to your trades. But the trades that I've taken all have positive comments, which means that my efficiency is running at 100%, and you'd expect it to be, or close to it, because I've been fucking trading for 25 years. So you would see, if we went back to the journal, the tilt meter here constantly being green. Performance by instrument. So again, 9 trades. You can't take anything away from this. But this is what Edgewonk would do for you. It would just organise your returns by instrument. So you can see just over this period, my best performer is the euro dollar, which I've had 3 trades in. Worst performer is the dollar CAD, which I had 1 trade in. And then you can look at performance by setup as well. And you can see here that my best performing setup is the daily bias last low pre-break trap, which there's only 1 trade in it, and that was obviously BTC. So because it made 3.7 and there's not a lot of trades in the sample size, it's shot to the top. Interestingly, the mean reversion strategy has had 4 trades and it's doing well. So you can see there that we've had 3 winners and 1 loser trading the exact same strategy every time, which is that mean reversion trade, trading a good level when the market's past ATR. Performance by time is another one that you can look at. Let's put that by weekday. Wednesday, the best performing day. No trades taken at all in any of the live day sessions during the month. Although, interestingly enough, if we filter by exit date, so not the day that I got in, but the day that I got out, look at Thursday there. Thursday's the best performing day of the week by far. But that's because it's the day that I closed out the long BTC that I called you. And then obviously I had that gold trade that you saw me come into the session with that hit target. If I change these to entry by hour, you can see just a breakdown here of the different times of the day and the return for each of those. And again, over time you would see that there would be a lot of variance. Like I've said before, I don't trade to any specific time windows. Performance by day, just looking at this, you can see a breakdown. I don't want to keep saying this is not statistically significant. You should obviously be aware of that. But this is exactly what you'd be looking for if you had a statistically significant sample size. My smallest up day is towering over my biggest down day. You want to generally see that you're having more up days than down days, and that your up days are larger than your down days in terms of how much you're winning versus how much you're losing, and that constitutes the foundation for a good record. Risk distribution here, you'll see that most of my winners land within 1.5 to 2R. And you would see that over time. Here you can see obviously where the outliers start just over this sample size. The outlier of that crypto trade, which took me in the realm of 3.5 to 4R. And then the maximum to the downside is 1 to 1.5R. What you can do is you can go to a simulator, which Edgewonk has built in, which can use the KPI from your trades and we'll start simulations. So here I've got it simulating the next 500 trades and getting it to run 50 simulations. So you can see what the curves look like if I keep up these KPIs. Now, what's very interesting about this is that even with returns as good as these, it is possible to hit a large number of losers. 12 could be the longest losing streak in this period. And that is something that's really good to know, because knowing that really helps you when you maybe have 3 losers in a row and you start doubting yourself. If you're able to visually see an equity curve like this over 500 trades and understand it's okay, because it is possible to have 12 losing trades, then it helps with mindset massively. So you could take off these KPIs and you could totally change things. So you could say, well, what would happen if my win rate was 75%? You could maybe change this to average gain is 1,000, average loss is 500. So it's only a 2R, and then start your simulation again and it will give you all the curves. And here, because of the 75% strike rate, you'll see that the largest losing streak you're likely to encounter is 6. So KPI is the key metrics from my trades. So what that's doing is it's taking all the trades that I've entered into the journal, and then it's saying if I keep up that performance, that's what my equity curve will look like. So some of the things you can do with Edgewonk is test ideas to become a better trader. Now, Edgewonk actually alert you to things that they automatically pick up from your trading. You'll get the notification bell go off. But naturally, you want to do your own work. I'll show you a few examples of custom statistics here. Now, again, there's not a lot of data here, but someone asked me the other day, Tom, I'm long a market coming into news. Should I just hold the trade or should I get out? And I didn't answer them because I didn't want to influence them. And I also thought my answer of, well, what does your journal tell you to do, might have just sounded a bit condescending. But you can track things like this if you're unsure of them. So if you go back to the journal here where I've input all the trades, and under the top trade, which was the last trade I took, which is the one that we've covered, the weekly open test, if you have a look at that, you can see under the advanced trade section that I've entered a custom statistic of this being held over market related news, because that trade was held over market related news. I held it through a fair bit of news actually, but the biggest piece of news I held it through was the US consumer confidence figure. And I also went back and checked for all the other trades taken in the month, whether they were held through news as well. So now if I was to go back to the custom statistics here, I can see the result of holding trades through news and seeing what the P&L is. In fact, over half my P&L on the month was made holding a trade through news. Now, some of you might think, well, hang on a minute, that shows what you made holding through the news, sure. But it doesn't show what you had before the news. You could have been 10 grand in profit, then the news came out and you reduced to 5 grand on an adverse news effect. And that is totally true. So you could then break things down further and you could test, when I come into news in a certain trade, what's the result? And you can basically track these things. But there weren't any trades that went against me on the news. There were only 3 trades out of 9 on the month that I held through news, and all 3 of them, the news drove it to target. My favourite section. Am I garbled? Someone's saying I'm garbled. Sounding like a robot? Okay, that's fine. My favourite section, trade management here. One of the most useful, I think. So if we just go to journal quickly, when you fill in a trade like this, so say in the euro dollar, under advanced trade, you can fill in, was the OTP hit? Now what that means is, did it go to your original profit target before it went to the original stop? And then that is tracked for you over time in the trade management section. So what you'll be able to see here is that the blue line is my equity curve. The yellow is the equity curve that would be achieved if I didn't manage my trades. And the difference between them is the orange curve. So managing my trades actively, rather than just taking a hands-off approach and saying stop or target, is outlined down here. The outcome of that is 1.8 R that I have made managing my trades. Now, I tend to outperform doing nothing over time, but many people don't, so it is well worth noting. And if managing your trades had caused you to lose money, then this would flag it up pretty quickly and you'd be able to see the exact impact in R that it is actually having on you. So again, my actual performance was 9.82 R. If I had come into all of these trades and just said stop or target and I'm not managing it at all, the actual realized result would have been 8.02 R, which is still good. And incidentally, and this is very interesting, again, only 9 trades here, but if you've got a huge sample size of trades, let's say you've got 500 trades, and you still find that trade management is only coming out slightly ahead like this, then you may think to yourself, you know what, I will stop managing trades and accept a slightly lower return because of the amount of time I save and the stress I save. As I've said before, the holy grail is making the most amount of money for the least amount of time. So if you are able to come in and say, once I've taken that trade, I don't have to look at it again until it hits stop or target. And over 500 trades, yes, it's going to mean that I make 2R less. But how much time do you save? How many decisions do you not have to make about whether to trail your stop, and is it going to hit this new stop before it hits the target, and so on and so forth. So there is something to consider there, but I outperform a passive approach quite substantially. But again, just something that you might want to be aware of. Another thing here, under the strategy lab, under alternative strategies, you can test alternative strategies. In this example here, I've tested alternative ways of trailing stops to try and capture moves. I initially thought, oh, I'll test the result of moving to break even, when 50% of the way to target. I'd love to have done that for you to prove it performs so badly, but the universe shat on my plans because over these 9 trades, the outcome wouldn't be any different because none of these fuckers came back once after moving halfway to target. So across these 9, if I'd moved to break even at 50% of the way to the target, it would have made exactly the same return. So there's me thinking, oh, I'll prove to you that break even doesn't work. Well, unfortunately, I haven't been able to, but don't worry, I'll still continue trying. But here you could try different ways of managing trades. So, for example, I took every single one of these trades and tested what would happen if I had no target and I just waited for the first hourly candle to get into profit, and then I just trailed a stop behind every hourly candle until I'm stopped out. Now, to make it quicker, I just tracked it in P&L as opposed to R, but you can see on some of these trades some interesting metrics, like for example on the weekly open test, if I trailed with a trailing stop under each hourly candle, I would have made a lot more money. I made a profit of 1,852.50 on the theoretical 50k balance. Trailing a stop, I'd have made 2,710.83. Now, why is that? Because have a look, if I pull the chart on the screen, what happened? I got out at the weekly open, but if you have a look, where is the first candle that pulls back under a previous one? And it's there. So look at where my exit could have been if I followed that strategy as opposed to where I got out. So I then went back and tested that across all of these different trades, and some of them you'll see a disparity, some of them you won't. If I tried that on the gold trade, I would have gone from making 2,391.69 to only 342.81 because it chopped for a bit before taking off. So again, you can't read anything into this, but what I'm saying is that you can try interesting things like this, and as you get a bigger sample size, you can start testing. What about if I do this? What about if I do that? Now, you have to input the data yourself. Edgewonk not going to automatically do this all for you. There's still a lot of work involved, but Edgewonk is essentially presenting the information that you put in and is able to then give you the charts and allow you to read that information quickly and easily. Now, you can import data into Edgewonk. You can connect it to your broker and just import all your trades, but I never do because I'm one of these people that is very meticulous and I don't trust anything. I'm the kind of cunt that will use a fucking calculator when I'm using Excel. I have to have everything done to my own satisfaction. So rather than just import all my trades and be like, that's fine, I've got to input them manually, even if it takes me more time. But it really doesn't actually take that long to do things, I find, once you get adept at it. So one more thing I'll show you here is this exit analysis. So here under exit analysis, you can see my up draw v down draw. Now again, that's dependent on the figures you enter when you enter the trade. If we go back to my journal, when I take a trade like this euro dollar, I'm going to fill in under advanced trade the highest price it went, which was in this case my target, and the lowest price, which is how much drawdown did I go into. So when I entered the trade, how far did it go offside before it hit my target? In actual fact, in this euro dollar trade, I didn't even go a pip offside, but that's quite rare. But if you look at, say, something like this euro dollar trade beneath it, you'll see here on the advanced trade, I went long at 110.85.9 and it went down to 82.8. So I went a little bit offside on that. But anyway, that aside, you're entering the data there, and then you're seeing down here your exit analysis. So your up draw v down draw. And the first thing you should be able to spot, if you're quite good at reading data and you're quick with patterns, is that the top 6 trades, so 1, 2, 3, 4, 5, 6, that hit my target, which is the top green line, none of those trades went more than 50% to my stop. As a result, you should immediately start thinking, if I halved all my stops based on this data set, well, what would have happened? I would have had a full loser on trade number 4 because it went over 50% of the way to the stop. So that I actually ended up taking a small loser on of 0.09R loss would actually have been a 1R loss if I'd reduced my stops by 50%. Trade number 8 in the sequence over here, there would have been no difference to. And this trade here, number 2 in the sequence, there would have been no difference to that. But all of these other trades, their R would have doubled, meaning I'd be massively ahead of my current performance. Now again, you don't make drastic changes based on 9 trades, but you think about them and you start to see patterns. Again, you can do lots of things like this to improve your edge over time. So in terms of what we've looked at tonight, we looked at creating a trading plan, how that translates into your flowchart for fast forecasting, how that translates into the daily Excel sheet that you update your plan on each day, how that translates into the trades that you take, how that translates into your journal. And then once you have finished journaling your trades, then obviously you want to conduct a proper performance review at the end of the week. And I've posted the one that I use in terms of performance review before to Twitter, but just to remind you, these are the questions to ask yourself. And you can do that quite nicely as well with Edgewonk by creating a session. So if I go to diary and I go to sessions, if I go to add period, I can take the last week of trading. So it's the last week of trading of VFL from Monday the 23rd of September to Friday the 27th. And it updates automatically down here. I had 3 trades, 2 winners, 1 loser, no break-evens. This was my strike rate over the week. This is the amount that I'd have gained on a 50k balance. And this is the gain in percentage terms. This is the R multiple. And my tilt meter's working. But what you can do here is you can then select weekly performance review, which is something I added. And you can just write down your answers to the questions in this section. So I did prep this a little earlier so I don't have to suffer the indignity of you seeing how many mistakes I make when I try to type really fast. But you would enter something like this. So what worked well this week? This is me talking, by the way, from last week. Using caution to stand aside from the potential sell in the Aussie dollar due to the speed of the retracement. So you remember I was very skeptical about the Aussie dollar. If I'd have traded that, yes, I would potentially have got a little bit on side when it started to react, but I was more likely than not going to get caught there because it did fail, and it did fail fairly quickly. So I was basically paid to be cautious. It was the right decision. Now, if I just pull that Aussie dollar onto the screen, you could look at that and say, well, Tom, the area that you wanted to sell, which was the low of this shooting star, it formed another shooting star off of it. So you could have moved your stop beyond the high of that, and it would have taken you out for only a small loss. So even though you read it wrong, that there was going to be this big move to the downside, if you traded your rules, you still could have got away with only a very, very tiny loss, basically a scratch. And that's true. But when I'm listing things that worked well this week, it was not taking that trade, because essentially it didn't work, and it would have been at best a scratch, and at worst it would have been a very small loser going into the book. What didn't work well last week, neglecting to analyse the pound yen, because as we went through on Friday, there was a missed opportunity in that pair that should have been caught. So now I'm already thinking, well, what's the problem here, Tom? Oh, I missed a profitable opportunity. That's the problem. Why have I got that problem? Well, I reduced the number of markets I looked at over EFL to keep the focus tighter. So I stopped really looking at Euro JPY, Pound JPY, and wheat. What is the solution? Add those markets back in going forward. How can I action it? Already actioned it. So you can see what I've done here is I've nicely laid the blame on you guys. Rather than having to accept the blame myself for not doing the analysis, I've basically said it's all your problem, it's all your fault, because I wanted to make things simple for you, so I stopped looking at those fucking markets. And that's what you should do. Never lay the blame at your own door. No, I'm joking. That is the sign of a proper cunt that pushes the blame elsewhere. But you've just got to be honest. This is genuinely the honest truth. I stopped looking at those markets. I did want to be a little bit more focused over EFL. You haven't heard me mention wheat. A lot of people have been saying to me, do you trade euro yen and pound yen? Because you never mention them. And I'm like, I do trade them, but I haven't traded them over EFL. I haven't looked at them. And it's sod's law. I've missed a decent trade. So, it's okay, but I've got to understand that's why I missed the trade. The solution is get those markets analysed going forward, and it's already actioned. They're straight back in my watch list. So you have your weekly session conclusion. You save it. You can be as detailed as you want. You can even give it a rating out of 5. How good was the week? And then you build up that track record going forward of performance reviews. So you can see everything is kind of circular. We're starting out with a plan which will adapt over time. We build a flowchart of our setups. We start trading those setups, coming in every day with our plan in Excel of what we're looking for, what we want to see, where we want to see it, when we want to see it. We take those trades. The trades go into the journal. We learn more about our trading and how we perform from our journal and from our performance reviews. And that in turn goes and affects the plan, because we'll come up with things that will help make our plan even more concrete. We'll decide that some things we put in maybe aren't relevant, or some things we put in we need to expand on. And over time, your plan grows to a stage where you don't really need to read it anymore. You've been over it and revised it so many times, you know it inside out and back to front. But it then takes its place up inside your head. And it's very much like that for me with the flowcharts. When I pull up this flowchart, I fully understand that it looks quite confusing for a lot of people, but I am not trading with that in front of me. All of that is going on in my head. If this happens, I know what to do, just because I've been doing it for so long. And again, remember, this is a very condensed flowchart. There's a lot that's been omitted from this, and you'll see if you start building your own how many things you have to be aware of. And I do think that's quite a good idea, because it just might get you to think of things that you haven't considered before. And typical ones I do see people haven't considered are based on the questions I get all the time. So people say things like, well, news is coming out and I'm in a trade. What do I do now? Well, you fucking tell me. If you put your trades in a journal and you've recorded that metric, you'll be able to tell me exactly what to do. Another question. This trade's amazing, but it's only a 0.95 RTOM. Do I take it? I don't know. What's your strike rate on this strategy over time? And so on and so forth. So you come up with answers because you've done the work and you know how to execute based on that experience. I have to crack on with trading tomorrow, obviously, because tomorrow night's our last session, and I want to impress you all by leaving you with a nice trade. So I'm going to have to really try and force something tomorrow, aren't I? I'm really going to have to steam in tomorrow. But the beauty of that is, if I do my arse, I blame you again. So it's like, well, guys, I've done my arse on a trade, but I just really wanted to impress you, so it's your fault once again. Cheers. No, I'll see if anything sets up tomorrow. There's obviously the potential that we're going to have good old crude oil, which will be very exciting. I might have to extend DFL if that's a loser, because that's going to really piss me off. I'm not going out on a losing trade. Fuck that shit. I've ended it so far with a beautiful winner in the euro dollar. I am not going out on a loser. That fucking oil better work, because it looks like it's going to get a fill. Anyway, the order's been cancelled Friday night, so as soon as that bad boy opens, I'm putting it back in. And everyone keeps asking me, am I worried about these highs? I'm not worried, but I'm watching them. I'm watching that very, very closely. I'm watching that about as closely as you would if you had your kid with Bill Cosby. It's got to get down through it quite quickly. Otherwise you could get trapped. Don't think I've got anything else to say. Thanks for the financial advice. Ah, you got me. You got me. Read the disclaimers. This is not financial advice. Tom, aren't you worried about the recent developments in the Middle East regarding the oil trade? Well, let's see where it opens. Every time I've tried to consider fundamentals in my trading, it hasn't worked for me. So many times I've been looking to take a trade and I've thought, do I really want to do this? We're on the fucking brink of nuclear war here. Do I really want to sell the bunds? And then suddenly the bunds tanks and I think, oh shit man, I should have sold that. So I've just learned, for me, to not really get too concerned with the news, especially because I'm not looking for absolutely massive moves. You know, in the short term, as long as this gets back beneath this blue level, I would already have a protective stop in place mitigating risk. So yes, there's a fairly big target, but it doesn't really have to move very far for me to be able to totally reduce risk on it. Tom, if you have time, could you explain range trading recruitment process? I'm going to get Ryan on tomorrow night to talk to you all, because I've had a fuck enough of you lot. Only joking, I love you all, but I'll get Ryan on tomorrow night. Phoenix says, I'm coming, Tom. Wait for 6 months. Yeah, I'm waiting. It's lonely at the top here. Come and keep me company. Oh. Anyway, I'm out of here. And let's see where that oil is tomorrow. Cheers, guys. We'll speak tomorrow night.